Hello, everybody. Thank you so much for joining us. This is going to be a very special and specialized webinar. I'm very excited about it. It's obviously one of the biggest questions in crypto is how do we understand tax implications? So we have our very own Ben Gaffey, who's our controller. We have Pat Larson. This is fantastic. Thank you, gentlemen, so much for joining us. Pat, thank you so much. And can you tell us about ZenLedger and everything that you're up to?
Yeah, sure. So ZenLedger is a 5-year-old venture-backed startup. We help cryptocurrency investors and accountants and investment advisors with cryptocurrency accounting, tax, audit, tax loss harvesting, and portfolio tracking. So we help you with all that. And then his personal background, used to be a Navy helicopter pilot, U.S. Chicago MBA.
Impressive. I don't know why you went quickly over that one. That's very, very
A lot of
impressive.
people have credentials on this call. So.
Yeah. Wow. And we at Valkyrie do a lot with, the veterans in digital assets. So it sounds like we have a topic for the end. If we have a couple extra minutes, maybe we'll pick your brain. Fantastic. Well, it's a real pleasure to have you. Thank you so much. And Ben, hello. How's it going? And can you tell everybody a little bit about your background as well today?
Sure. As Leah mentioned, I'm Ben Gaffey, the fund controller at Valkyrie Investments. And before joining Valkyrie back in August of last year, I spent 12 years at Ernst & Young performing audits for asset managers and various funds.
Love it. All right. So we got the CEO of ZenLedger and we got our very own Ben Gaffey. The way it's going to work today is I am actually going to sit back and listen to these gentlemen. Because Ben is definitely the expert here. It's going to be a fireside chat with Ben and Pat. I will be looking for any questions you guys throw in the chat function. I think that I probably will be able to get in a couple at the end, but I'm really looking forward to this. And Ben, I hand it off to you.
Thanks, Leah. So I guess Pat will start at step one, which is how are digital asset transactions actually taxed in the United States?
Yeah, so it's a mishmash of property, commodity, equity, and we're still trying to figure it out. There have been a couple IRS rulings, like a 2014 ruling that laid out some groundwork. In the 2018 tax bill, there was a little bit saying that 1031 exchanges between crypto is not allowed. There was rumblings in the Build Back Better plan and in President Biden's recent executive order. So we'll get a lot more clarity in the next couple of years. We were just so early on before, and adoption was pretty low, but now you have Super Bowl commercials and Fortune 50 companies, all with blockchain and cryptocurrency projects. So basically, you can think of it mostly as a tech stock, and that's helpful for your own accounting and personal taxes. So anytime you buy cryptocurrency with your dollars that have already been taxed, that's a non-taxable event. You've now acquired cryptocurrency and sold your dollars to acquire them, just like if you're buying Tesla stock or something. As you hold cryptocurrency, there's no taxable events. We don't have a wealth tax or anything. If you bought Bitcoin and held it for 100 years, there'd be no taxable events there. If you earn income from streams or think of them as dividends in crypto, that is generally taxed at other income tax rates, and that depends on your own tax rate. And then when you sell crypto to crypto or crypto out to dollars or fiat, that is a taxable event, just like selling your Tesla stock. And so there'll be a long or short-term holding period, long or short-term capital gain, again, depending on your personal taxes. NFTs, we're still trying to figure out if it's sold as a collectible, if it's 22% or whatnot. A lot of NFTs are built in a couple different ways. And then decentralized finance, DeFi, where you're staking and you're earning a lot of tokens as income. That's generally pretty clear that it's earned as income. But once you say you stake a token, you earn one token within 6 months, then that's taxed as income. And then say you sell that token immediately, the capital gain on that token is also long and short-term capital gain. So there's just a lot of different crypto flavors. So there's a lot of different tax treatments and nooks and crannies to think about.
So obviously a lot to unpack there. So let's start with the 2014 disclosures around the IRS. So I know that covered mining and mining income, but you also mentioned staking. Right. So in terms of how we approach staking from a tax standpoint, correct me if I'm wrong, but that's really just based off of parallels to other items. And really, there is no actual regulation around or rules around that portion of the cryptocurrency market?
Yeah, like we haven't had a comprehensive cryptocurrency tax bill that said like, hey, all these senators and congressmen have thought about this, and like here's the rubric for everything, and here's how we're going to account for it, and here's the government agency that's going to be in charge of it, and like all of that. Like we don't know. SEC, CFTC, like not sure. And so you kind of have to rely on your tax professionals. You have to rely on a little bit of case history that we're seeing, but we haven't seen a lot yet. And you have to make your own personal decisions. Do you want to be super aggressive? Do you want to use like last in first out accounting method? And do you want to keep millions of dollars like in your possession that you think might actually be profits, but you can like 3x or 5x it, and then pay your 6% like penalty on that? Or do you want to be super conservative, first in first out, label everything as kind of like max profit and pay your taxes on that because you're worried about audits and compliance and being on the board of some investment company, and you can't risk even being under audit. Like it completely depends because there's so much gray area right now.
So with all that gray area, I know at ZenLedger, I'm sure you deal with all the various crypto custodian platforms.
Mm-hmm.
So how are they handling the tax reporting to their clients compared to, the traditional brokers like Fidelity?
Yeah, so like a Fidelity or an E-Trade or anything like that, they have custody basically of your stock certificates, and they will know the cost basis you acquire those stock certificates at. So they can give you a 1099-B, which comprehensively says, here's your cost basis, here's your profit and loss in your holding period, and they can send that to the IRS or the SEC and to you and to your accountants and the lawyers. Cryptocurrency custodial exchanges in the United States do have some sort of reporting requirement that's loosely defined based on the IRS winning a lawsuit against Coinbase in 2017, 2018. But again, like a lot of wiggle room in there, and we're not really sure what's happening with like a $20,000 like reporting. So a US-based exchange can create a 1099-K, which is aggregate trading activity, but you could trade one Bitcoin back and forth 100 times, have 10 million of aggregate trading activity, and have a small loss. And the IRS is going to have no idea. Once you're moving your cryptocurrency into your own custody on chain and then to another exchange, you've destroyed the cost basis, because when you move cryptocurrency around in your custody or on chain, it only accounts for itself in its own token. So you move Bitcoin around, it accounts for itself in units of Bitcoin. If you move Ethereum around, it accounts for itself in units of Ethereum. At no point is that blockchain marking to market in dollars or euros or yen. So you need software like ours to peg every time you have a taxable event or a movement. We will price it in your currency, say dollars, at that time. So you can like add gas fees to add to your cost basis. You can maintain cost basis from day one, 7-8 years ago, have LIFO or FIFO flow all the way through, and know your long and short-term capital gains and the tax impact of the next trade, the next incremental trade. We can tell you what the tax impact of your next move would be.
So just to clarify, you're saying if I have a Coinbase general custodian account where it's not my actual wallet and I'm trading, 3 or 4 different coins, but then decide to move one of those to a Coinbase wallet account, which is a completely separate portion of their Coinbase system, they are no longer able to provide me with the appropriate reporting for me to calculate my taxes?
It gets iffy. So Robinhood is a walled garden where you're not allowed to deposit or withdraw cryptocurrency, and so they can give you a 1099-B. Coinbase is a custodian that allows you to move on and off chain, and they have done a lot more work in the past couple of years to make sure that Coinbase, Coinbase Pro, GDAX, Coinbase Exchange, and Coinbase Wallet like will sync. But like I'm not 100% confident if you are doing trades between only your own Coinbase accounts that it would come out like perfect. And then as soon as you move over to MetaMask, it's done. Like they've lost the thread.
So it seems like you're basically on your own from a tax reporting standpoint. Obviously, utilizing certain applications that are available could help out. One of the good news, not to harp on all the bad news aspects, is the fact that currently, I believe wash sales is still not applicable to cryptocurrencies. Do you feel like that's coming down the road when it comes to, Congress passing laws, or how would that
Yeah.
impact the tax world of crypto, making it even more complicated?
Yeah, so currently there's a wash trading rule against public equities because the abuse was so bad. Like 1929 was so bad that we had to create the SEC, right? And all the abuses before, and like so, the wash trading rule is one of those things where if people don't know, it's like you take your share of Amazon stock and you it goes down 5%. You buy it today, it goes down 5% for some reason. You sell it immediately today and buy it right back, and you say, hey, I get that 5% of loss, that whatever that $50 of loss, I'm reducing my tax liability by. Even though like nothing's really changed economically, you still hold one share. You're just kind of like stealing a little bit of tax liability from the government by doing that. And that's why they call it a wash trade, because economically you've achieved nothing, but now you have a tax loss asset. In cryptocurrency is not a publicly traded equity. It's like we don't know what it is. Maybe it's a commodity, maybe it's this or that. So theoretically, you can like buy Bitcoin right now, it goes down 1%, you sell it, buy it right back. And now you've captured a $400 tax loss asset in that 1% move, but you still own one Bitcoin. And our software will let you do that if you want, but you don't have to. And you can tax loss harvest at the end of the year, December 31st, or you can do it in the middle of the year. We generally recommend you, like if you're very conservative, wait 30 days, right? If you're a bit more aggressive, maybe 15 days, 10 days, whatever, like it's completely gray. It's completely between you and your tax professional and what you're going to file to the IRS. And it's really indeterminate, like what the right way to go is here.
Yeah. So once again, even complicating the issue even more, there's been some questions around the use of cryptocurrencies to purchase goods or services.
Yep.
So that, once again, a taxable event, just like every other crypto transaction you mentioned. The question is, do you actually have to understand the costs of the goods and services to appropriately account for your tax gain or loss there, and what are some suggestions around those transactions?
So if you use stable coins, you can make your life a bit simpler. Stable coins generally only fluctuate like 1 cent versus a dollar. It'll be 99 cents or $1.01 to the dollar, and so that'll like greatly minimize any slippage. If you're using like USDC and the markets or the Ethereum's very clogged, you might end up paying a lot in gas fees just to get that one purchase done. It's still not a good way to buy a stick of gum or a gallon of gas unless you're using like a much faster, low transaction price blockchain stablecoin. If you're buying with Bitcoin or Ethereum, you will incur a long or short term capital gain or loss based on the purchase you made. You buy a $5 latte with Bitcoin. When did you buy that 0.00001 Bitcoin, and how long were you holding it for? What was the cost basis of that Bitcoin? And then what's your personal tax rate on capital gains? And then it flows all the way through, but it is a taxable event.
So moving away from just the general transactions of one coin to another, let's circle back to staking. So one of the more publicized current events of the staking world is the Jarrett versus United States court case that's going on right now. So back in, I believe, early February, the Department of Justice went ahead and approved a refund of Joshua Jarrett's money, which, for the backstory of that, a man named Joshua Jarrett had some staking rewards, filed his tax returns with that showing as income, and then subsequently filed a refund request on the basis that those staking rewards should not be taxed at the time of receipt, but taxed at the time of disposition. So once again, last February, or beginning of this February, the IRS went ahead and said, sure, we will give you a refund. We approve the refund you requested, but he actually denied that refund. Could you speak to, I guess, your thoughts on the case, why he denied the refund, and why this act of the IRS saying that he could have a refund doesn't really lead to precedent from a tax perspective?
Yeah, I mean, I think one thing is he wants to try to win in court and set some actual precedent here. Like, he's obviously very pro crypto and wants to fight for crypto friendly legislation. And maybe we're not going to get it. It's like a 50-50 Senate split. So maybe there's a court strategy to trying to force more favorable tax treatment and general economic adoption of cryptocurrency. The thing is that the legislature could pass a law. Well, first of all, there can be appeals to this case, right? So we'll see what happens with appeals. And then the next thing that can happen is legislature could come out and approve a bill that directly countermands whatever the findings of this law were. And then you'll just have another set of appeals, right? So I think we're still a long way off from Jarrett or any other cases really determining anything. And any bills or executive orders you see are a lot of, let's do some research. Treasury shall do this, shall do that. And then someone's going to challenge it in court, and it'll take years and years to get that case law in place. All the laws and rules we have today are the amalgamation of whatever, 100 years of case law at this point,
Great. So we've spent a lot of time on the U.S. taxation. So just to make sure we're covering our basis, in terms of the U.S. versus other foreign jurisdictions, how have they progressed in their crypto regulation from a tax perspective?
Yeah, I mean, as a general rule, the United States is always the most convoluted and sometimes the most aggressive of tax regimes, and that's why corporations can do things like go to Ireland or the Caymans, and that's something we contend with as well. You do see other countries being much more accommodating to crypto. You see Switzerland having a crypto valley and trying to attract entrepreneurs and capital to start or at least base domicile the startups in Switzerland so that they continue to be an innovation and finance hub. And then I think, let's see here, was it Portugal? Will I think capital gains are tax-free on crypto there. So they're obviously trying to attract people and capital. South Korea, their conservative prime minister that just got elected, or their president, is very friendly towards crypto and is trying to add a $40,000, 50 million won, kind of de minimis there on profits. And again, it's a small country that's very connected to the world and global markets, and they're forward thinking, right? They don't dominate international trade, but they want to participate and they want to be somewhere where you can arbitrage, like in Estonia, Switzerland, Singapore, South Korea. It makes a lot of sense to try to be inviting to a new capital regime that's not tied to dollars or euros or yen that you don't print, that you don't control. And then there's places like China that have tried to ban crypto, mostly because it was a great means of getting your capital out of China and away from the regime, and they didn't like that. And it was completely ineffective.
Thank you. So unfortunately, it seems like the U.S. is not behind. So there really isn't a framework set by other countries or other jurisdictions. So how do you see this all going over the next 3, 5, 10 years when it comes to Biden? I know you mentioned it's just you should do this and you should do that, but he sent that executive order saying that it's time to focus on crypto. So do you think that's a light the fire kind of thing, or do you really think it's going to be a 5, 10 plus year event here?
Yeah, I mean, I think in general, we like to think that history is much cleaner, because when we learn history, it's one sentence here, one sentence there, that this thing got hashed out or this bill got passed and it was important. And we don't realize all the horse trading, all the fighting, all the lawyers, all the lawsuits, all the gnashing of teeth and jurisdiction arbitrage and regulatory capture and everything, right? So in the United States, we have an incredibly powerful finance sector, and they lobby like crazy to maintain their monopolies or duopolies or cartels, and they don't want to give any of this up, and they're starting to co-opt some of crypto, right? They ignored it, and then they try to co-opt it. So there's investment into cryptocurrency companies, there's acquisition of cryptocurrency companies, there's lobbying for a stable coin that would be issued by JP Morgan and not Circle or something, right? You're going to see every Fortune 50 bank is a tech company now and wants to have a monopoly on crypto, and every tech company wants to be a bank or a payment processor, and they want their own monopoly on crypto. So you're seeing every payment company, every finance company, every bank, and every tech company go after like these rails because they want 30% of every transaction or 3% of every transaction, just like anyone else, right? There are different factions that you can see inside Congress, like Andrew Yang, Blockchain Caucus, Senator Loomis, like they're trying to give clarity and some adoption here. And then there's, like Senator Warren seems pretty against cryptocurrency. Chairman Gensler of the SEC seems pretty against cryptocurrency. But like it's just, so it's like way too early to figure out how any of this will hash out, and also how the international dynamics will work, right? Like you see people fleeing capital to Puerto Rico. You'll see other capital flow away if things are too restrictive here, and we'll just kind of like lose out on kind of innovation and capital flow for a while, and then we'll probably overcorrect the other way. That is my thought. I think we'll get it wrong at first, and then we'll have to correct.
Speaking of Chairman Gensler, obviously for those uncomfortable with direct investment into cryptocurrency, there are products out there to be able to get that exposure in the crypto space. Any thoughts on what's out there and how that can be used to maybe avoid some of the complicated tax structures of
Yeah,
crypto?
I mean, I believe there's an SEC approved Bitcoin futures ETF out there, isn't there?
Of course, the BTF for Valkyrie is obviously one of our flagship products. But beyond that, in terms of non-exchange traded products, there's obviously some trusts out there that you can invest in. We have a line of them, but once again, that is a direct investment into crypto. So the tax complications do come with those.
Yeah, I think there's a lot of interesting things to do here, and it's up to the investor, like what percent of portfolio you want to mess with and how much of a headache you want to deal with versus the potential upside, right? Like, is Bitcoin gonna 10,000x again? I don't know, unlikely, right? But but there are other tokens that have 10,000x in the last year or two, and there will likely be others that will 10,000x in the next year or two. So like having exposure to that kind of alpha and beta is like very interesting, right? And if you're a little worried about inflation and money printing, and you think that gold and Berkshire Hathaway and Bitcoin might all be like interesting parts of a defensible portfolio, then like an ETF that tracks Bitcoin and the underlying is really interesting. Valkyrie's DeFi fund that we are actually doing the fund accounting for is also a really interesting play. There's just like a lot of interesting ways that cryptocurrency can give you access to underlyings, whether they be equities, fractional real estate, fractional token that's like that monitors the overall value of Bitcoin or Ethereum or whatever else. There's just an ever increasing variety of interesting like investments here, and that's also what makes it tough. Like, it's hard to decide what to invest in, and then it's hard to account and comply with taxes and regulations once you've decided to make that investment.
So you mentioned DeFi. Obviously, the next step of crypto complexities, decentralized finance. Compared to the average investor in Bitcoin, what does DeFi add to the equation when it comes to tax requirements and transactional recording?
Yeah, so decentralized finance is just like a continuation of what Bitcoin is supposed to be, and like Web3. So Web3 is like own your own data, whereas Web2 is there are gigantic properties in the internet that collect all of your data, and you are the product, right? Just like you are the product of a bank. Your savings and your income and your earnings are loaned back out to you at high interest rates, and that feels weird. And credit bureaus just mine all of your life's history to decide if you should get your own money back as a loan at a high interest rate. Like that's a weird system, right? And so Web3 and DeFi is like saying, hey, I've taken my post-tax dollars, or perhaps my pre-tax if it's in an IRA, and I'm investing here, and I, like hopefully I guess it was an IRA, it's not custodied, but it's saying you custody things, you keep it on chain. So you're the only one looking after this stuff. If there's a hack and it's lost, there's no recourse. But that risk is compensated in a couple ways. One is control. There's no bank runs, right? You just control your assets and you can pull them out, move them around anywhere in space. Like you can bounce off a satellite. You can trade from an internet connection in the middle of the ocean. And then two is you get higher rates of return. You can earn 100,000 APY, or you can earn 8% APY on dollar deposits, US dollar deposits, not stablecoin deposits, but you can go to Genesis Trading and earn something like 8%. You can earn 4% or 3% of Bitcoin rewards, right? So there's much higher rates of return because there is higher risk, and so you're kind of rewarded for that. Is that kind of what you're asking?
Yeah, definitely. Appreciate the DeFi rundown. I know beyond just the rewards, those APY numbers can go pretty high up when you also are able to compound all the various tokens you can play in the space.
Yeah. And it's kind of like airline miles or something, right? Like we have a lot of corollaries to these things. Like trading cards make no sense. They're basically worthless. Like, why would I pay you tens of thousands of dollars for a Jordan rookie? Oh, because someone else would too, right? Okay. Like, but there's no utility to it. You can't even like keep a door from slamming shut with a Jordan rookie card or something. But we all agree it has value, right?
Definitely. So back to the outlook for possible tax regulation, specifically when it comes to all of these different areas of digital assets. We talked about DeFi, we've talked about general crypto, we briefly mentioned NFTs. Do you think they'll all be considered different asset types and different rules around each one, or do you feel it'll be more of a generic theory-based initial go?
I mean, I think America's economy is large enough and important enough. It's a pretty big ship to turn, right? And it's very federated. Like literally every state has its own, like, hey, we're going to go after NFTs as sales tax, and we're going to tax your income and capital gains from crypto, right? Especially if it's like in New York or California, that can be quite aggressive and is constantly auditing billionaires and Fortune 50 companies every year. Like they're ready for that fight, so they'll have it, right? Because the stakes is billions to each state. And then to the federal government, it's you're trying to bring in, what's the tax receipts? Is it 10 trillion or something? The GDP is like 20 trillion. I can't remember what the tax receipts annually to the US are, but it's a big number. It's 10 digits or 11 digits. It's one or the other. So like there's a lot at stake here, and you're just going to continue to see widespread innovation here. Like the next marginal client who walks into an RIA or financial planner or a CPA's office is a 30 or 40-year-old, and they probably don't own any real estate. They don't own a home. They have student debt. They'll probably have a high-paying salary, and they'll own fractional stocks or stocks, and they'll own cryptocurrency, right? And so like that will increasingly become a caucus, and every Fortune 50 company that trades or issues or transacts in cryptocurrency is going to push for some sort of regulation and clarity, right? All the investment banks want it, all the banks want it. So and increasingly, like name, image, likeness for college athletes, right? You're going to see that all attached to NFTs basically, because that's how they're going to monetize them going forward. Every gymnast, soccer player, football player, basketball player, they're going to have their own moments, their own trading cards, their own, hey, I'm going to sell like 100 NFTs for you to get a signature or a signed jersey. And so they'll all have income, and maybe they'll issue some token, or there'll be some Shopify of name, image, likeness, and everyone will be able to buy their own tokens of these athletes, and they'll trade based on their performance in the first quarter of a bowl game or whatever. Like it'll be a very liquid market. It'll be very interesting, but there'll be ways that hundreds of thousands or millions of people can now kind of track their income. Just like 10 years ago, we were talking about like, hey, could you issue a college student some sort of loan based on their expected future earnings, right? We've been talking about that for a long time. It never quite happened because it was too kludgy. But if software can actively track this, and we all love the market, right? And less regulation and more choice and more free flow of capital. So like, I think those things will be allowed to flourish, mostly because they'll move too quickly, and too many people will make too much income, and they'll fight too hard for it. And there won't be necessarily someone on the other side saying like, no, this is all bad. Like name, image, likeness, NFTs are horrible. They attack my business. It'll just be like, oh, we're just going to tax that, just like we've taxed everything else. Like you had income before, we taxed it. You have income now, we're taxing it. You had capital gains 10 years ago, we taxed it. You have capital gains now on this thing called cryptocurrency, which I still don't fully understand, but we'll just treat it like tech stocks and we'll tax it, right? Like I think that's probably what's going to happen. It'll be like a very lazy, it rhymes with this, and we'll just kludgely figure it out as we go. It's just like Airbnb and Uber were disruptive. Like we still don't know how to like deal with Uber drivers as contractors or employees, right? So we're not going to figure out crypto anytime soon.
Right. And obviously the NFT space within the digital asset world makes it even more convoluted. And some of the parallels have been to just artwork, right? So when you have to have the conversation with the clients based off of the paralleled rules around art collectors or art dealers or the other 3 categories you can fit in, how does that usually go? And can you explain a little bit around that?
So again, we're still early on, but like if you're issuing NFTs, you should be setting aside Ethereum and selling it to dollars and paying some income taxes. You'd be foolish not to, right? Like if you set up an art gallery in a town and you're selling art out of there and you weren't setting any aside to pay for sales tax, local, state income tax, and federal income tax, you're gonna be in trouble. People with guns are gonna come. They're called like the sheriff or the IRS, and they're gonna come to your business, your place of business, right? Like, and NFT sales are happening in the open. Like it's people who are known, that it's not anon projects. They're happening on chain. You're doing like a multiple day or multiple week marketing campaign to sell these NFTs. Like you should know that you should be setting this aside. Just like in 2017, 2018, people were making incredible profits trading on ICOs. And then the music stopped in early 2018, but you had the tax liability from all the profits you made in 2017. But now you had no cash to pay those tremendous like capital gains profits, right? And so a lot of people in 2018, 2019 were in a lot of trouble. 2021, massive amounts of income were earned in cryptocurrency through DeFi, staking, NFTs, and airdrops. And if you're not setting aside cash to pay your United States taxes in United States dollars, and don't realize that you have exposure because your ENS token could go down 99% in value, but your profits from the income and the capital gains are denominated in dollars. So like and they're offset by whatever 6, 9, 18 months. Like you need to like look at your portfolio and realize how much cash is required to meet your tax obligations.
And on the flip side, from a buyer standpoint, if those NFTs go down, correct me if I'm wrong, but depending upon how you categorize yourself comparatively to the NFT world, you could possibly not even be able to recognize some of those losses comparatively to gains if you're just a collector.
Yeah, like if you buy a house and it goes down 50%, which is what happened to everyone in 2008, like you knew the risk there. If you buy a comic book and it turns out like it's not worth what you paid for it, like you don't like go begging for like some cash infusion or something. Like you just kind of like have to deal with the outcome of your investment decisions and the whims of the market there. And especially in NFTs, where like it is just bits and bytes, in the end, right? And there's no case law to say you own like the IP to this or that, and some like Bored Ape Yacht Club is interesting in that way, and scarce art is interesting in that way. But like I think the opportunity here is for smaller artists to cut out record labels, and for smaller like things like that. So generating income much farther down in the slope, like instead of only the top 20 musicians making any money and 99.9% of all musicians never making any money, maybe now like the top 10% of musicians can make money, right? And like it's not Spotify and the large venues that capture all the profits and all the revenue in the art industry. Like that's hopefully there's some democratization. Certainly the rich are getting richer in crypto, but like crypto's only really been innovated on since 2017, like with the initial cash infusion from the ICO boom, right? Like so like we're still really, really early.
I appreciate that. And as an accountant, as a CPA, I can talk tax, even though I'm not a tax accountant, and that interests me beyond, including all the little details we've been going into. But to kind of back it up a little bit, let's say I'm just an advisor starting out, and want to navigate the asset class. What are some of your suggestions in terms of where I should start, what I should look into? Really, how do I dip my toe into the water?
Yeah, I mean, like, there's a tremendous amount of reading you should do, but there's a tremendous amount of high quality educational information out there. Andreas Anatopoulos, or how do you even say his name? But Anatop in YouTube is great and very non-scammy, very Bitcoin focused. But like, there's trusted people out there that you should listen from, and you should be very wary of anyone that's like issuing their own NFTs and tokens and trying to sell you those. Like, learn first about like the technology and use cases and everything first, and take it slowly. Bitcoin and Ethereum seem to be relatively safe investments in the area. Not that they are safe investments at all. They're extremely high beta, but overall, like, I don't expect any scams or rug pulls to happen if you're just buying Bitcoin or Ethereum on a centralized exchange, or moving it to your own custody. I think there's been so many attempted hacks that if it was going to happen, it would have happened by now. But like, there's general accounting and compliance that you should just keep in mind when you're advising your clients, and you should try to be able to see their portfolio, because you also want to like give them advice on stocks and real estate and insurance and all the other products, right? So like, but this is an asset class that's likely to stay around going forward. It might be like 1999 where you're like, man, these tech stocks are really overvalued, but like, here we are 23 years later, and it turns out like tech's a real thing, right? And I think like 20 years from now, it'll be painfully obvious that crypto is still around, right? The utility for international finance alone, just for remittance, means that'll be an asset class, let alone like all the other interesting things that are going to happen. But as an advisor, there's plenty of research you can do. Just go ahead and get into it. You're plenty smart to understand financial instruments, so you're plenty smart to understand cryptocurrency and blockchain. You don't have to understand cryptography, and it's not all about databases and coding. So like the general use cases you can understand. The tax law, you already understand, because you already understand tax implications of trading equities and bonds, and so you'd understand what's happening in crypto. And your clients are going to demand it, because like your older clients they'll have Thanksgiving or Christmas dinner, and then they'll call you up and say, hey, I opened up a Coinbase account after watching the Super Bowl ads, and now like 1% of my net worth is in Bitcoin. And so like, that's part of my portfolio now, right? Let alone the next marginal 30 or 40-year-old that walks through your door asking for advice.
Yeah, great advice. And one thing I wanted to touch on that you mentioned was use case, right? So obviously, the world of crypto is continuously headlined by Bitcoin, which use case not really parallel to a lot of the other coins that have come out since. So could you take that a little further and explain use case for various cryptocurrencies, and why that might be something you want to look into before you go out and buy Dogecoin tomorrow?
Yeah. So broadly speaking, there are cryptocurrencies with a use case, a utility, some tie to some value. And then there are cryptocurrencies that have no tie to anything, and they're meant to be meme coins. Just like GameStop became completely separated from the business it was representing, right? It was a political statement, it was a joke, and the price went all over the place because of it. And interestingly, that happened about 14 months ago, and it was a titanic thing, and then we stopped talking about it completely. We just, no one cares anymore. Like, when's the last time anyone cared about GameStop? But it seemed like 14 months ago it was reshaping all of global finance forever, right? So that's one. Like, calm down when you hear this or that is very important. Give it a little time. But so there are meme tokens like a Shiba Inu or Dogecoin, or any number of them, and a lot of these NFTs are kind of meant to be that too. It's just a joke. It's just a JPEG. Like, buy it for $10 or 0.01 Ethereum, and like, ha ha ha. And you're like, it's mostly social signaling, right? Like, why did I buy a hat with my sports team on it? Does it have any utility beyond broadcasting? Like, I'm in your group if I'm in the bar or at the game watching with you. That's all it's meant to do. It's not meant to be some claim on future assets and cash flows and voting rights of the team. It's just meant to say, like, I'm in this club, right? Like, that's all it's meant for. So that's what like Dogecoin, Shiba, and many NFTs are for. Just social signaling, just like, but then there's other tokens that are meant to be fractional claim on art, fractional claim on the U.S. Constitution, fractional claim on an NBA basketball team or a European football club, fractional ownership of data center output or whatever else, right? And that can be Bitcoin, Ethereum, and all these other blockchains, like AVAX, Sol, Phantom, and those all have different use cases, and they all have different reasons of existing. Just like Amazon and Tesla and Microsoft and Netflix all have very different like reasons for you investing in their stock. All these blockchains and these specific tokens also have very different reasons for existing and what they're trying to accomplish and what their exact use case is. Some are trying to be digital gold. Some are trying to be digital dollars. Some are trying to be a hedge against dollars, like all sorts of stuff, right? And then there are stable coins, which are meant to just track the underlying currency and just remove friction, right? So they're meant to cut out Western Union's 30% cut, or MasterCard or Visa's 3% cut and 30 cents. And they're just meant to transact and be a stable against the US dollar, while Ethereum or Bitcoin have high beta against the US dollar.
Yeah, that was one of the biggest surprises to me entering the crypto space. I am still relatively new, as I mentioned, an August start at Valkyrie, was all the reasons why these cryptocurrencies existed, not just the Bitcoin model. It's vastly different than that. Well, as you go through the thousands of coins that are available. So, although we have touched on it earlier, I would say some of the questions are still focusing around staking rewards. So we can revisit that. One of the so as mentioned, different use cases, and a lot of these protocols that are proof of stake versus proof of work like Bitcoin provide additional rewards, like you mentioned, to the coin holders that participate in the governance or validation of the protocol. So when you get a staking reward, I invested in Algorand a year ago. And I'm getting these rewards on a daily, actually, minute by minute basis. So a couple questions in there. One, how do I recognize, what fair value should I be using if I'm getting these things every single, 20 to 30 seconds? And then also, is it really setting a new, in essence, tax lot every single day I'm invested in these currencies?
Yeah. So with staking, like, there's a couple things to consider. One is the returns you're getting in the token, and two is like how the token moves against what you care about. So that's dollars. Then you're like earning 100,000% APY of Ohm, but like the price of Ohm versus dollar is going down every day. So you have to like figure out what that trade-off is, right? And it's not linear. Like you can have a 99% down in one day, or you can have a 10,000 up in one day as well. Like, so those things are tough in thinking through staking. Most staking protocols are gamified to create an incentive to sell other tokens like AVAX or Sol or Phantom or Ethereum, and put them more in that token and stake more and more, and keep it locked up forever, right? Like, they don't want you to ever withdraw what you've deposited, because it's a virtuous cycle for them. But some protocols like Phantom completely explode when that happens, because the leadership leaves and things get messy. Just like if Elon Musk left the company or was in a car accident or something, the price of Tesla like would likely plunge, right? So you're tied to teams, and you're tied to random externalities like hacks. Again, just like if a random managing director in Credit Suisse like turns out was like embezzling $100 billion for Iran or something, which happens apparently monthly at some international bank, and then it'll affect the stock price or something, right? But and then back to staking and rewards. Fractionally, the reason why we created the software is because it's impossible to do your taxes without software. Like, you need to track every single transaction from day one by the second, mark every transaction as taxable or non-taxable, mark every transaction fee or gas fee, staking fee as non-taxable, but price it in dollars and add it to your cost basis. And you have to do that over every year because FIFO and LIFO flow through. So your transactions from 2017 impact your tax liability in 2021. And that second by second income earning, our software can just do it for you second by second. So you don't have to think about it. You don't have to worry about it. If you want to do it by hand, then you can like maybe club it up and take the median price of a day, but then like you're doing that 365 times and you're like looking up the prices if you want to. Like, good luck. Like, Excel's going to break, and Excel's going to break when you try to like put in LIFO or FIFO tax logic and figure out what are non-taxable self transfers between your accounts and adding to your cost basis each time as well. Like, Excel's not built for this stuff. You really shouldn't be doing your crypto taxes in Excel. Like, everyone's used to doing their like taxes in Excel because you get 1099Bs and you have your W2s, but like we're not there anymore. Like, we've gotten to a place where Excel doesn't work. So
Great, thank you so much.
Pat, Ben, that was absolutely incredible. Although I realized, Pat, that before we sign out here, I would love to hear more about your story and ZenLedger and just generally how the technology works, why you built it. Walk us through the software as well.
Yeah, sure. So my quick background: grew up in Southern California, half Vietnamese, and went to the Air Force Academy for undergrad, studied chemistry, and then was a Navy helicopter pilot. I commissioned in there and was a search and rescue helicopter pilot and combat medevac with 2 combat tours, and then got my MBA at University of Chicago, mostly an accounting track or iBanking track, really. But I took a lot of the venture stuff. All the professors I keep in touch with are all the venture guys. I don't keep in touch with the accounting professors. And then a year of M&A iBanking, and then 10 years in tech. Ran a $100 million business at Amazon doing licensed sporting goods, which is fun because I'm a sports nut. Still live in Seattle, and co-founded ZenLedger in late 2017. I'd always wanted to start and run my own company. Fintech seemed like the right fit. Talking to a lot of smart people, cryptocurrency was going bonkers. It was pretty obvious that millions of people were going to be investing in cryptocurrency, and there were going to be government regulation and taxation of that. The IRS was already suing Coinbase at the time, and we were able to get seed investment together and form like a strong founding team. So we just kind of went with it and figured learn along the way. Odds are the company would fail, but that's okay. You just keep doing startups until one succeeds. It's like, what's your time horizon on startups? Like, the third or fourth one should be successful. You stay in the game and keep learning. But ZenLedger's been quite successful. We've raised 4 rounds of capital. Mark Cuban's invested, among other like top fintech and cryptocurrency VCs. We are actually raising another round of capital. So we'll be around for quite a while. We've built up to over a 45-person team, growing quite quickly. And what we do is we bring every transaction together from day one for you. And we support even legacy defunct exchanges like Cryptopia and Quadria GX, and we've helped Mt. Gox stuff, and we work with the IRS, and we work with their criminal investigation and cybercrimes division. So we help catch bad guys, which is awesome. I'm a very mission-driven guy, and it feels very good to go after human trafficking and all that. But we also work with Big Four accounting firms and their ultra high net practices. Senior tax partners use us for their personal taxes and for their clients. We work with Valkyrie's $100 million DeFi fund because like our product can actually do it. Whereas most other products like just kind of break down and fail. We work with lots of token founders, and that helps us like with testnet access and stuff. They'll give us help there, and that's why several blockchains have invested in us as well. So Algorand invested in the last round via Borderless Capital. And then there are several other blockchains investing in our next round. So again, like we'll have hand holding to get all of the transactions correct on these leading blockchains, like their top 20 blockchains. That's why they have venture arms, and they have a lot of economic activity on them. So like basically what we're meant to do is we're just meant to help you and your tax professional and your investment advisor bring all this together, make smarter decisions, tax loss harvesting, look at, tax lots and figure out what accounting method, what's aggressive, what's conservative, what's the impact of your next trade. We've won $250,000 refunds for our clients versus the IRS. The number 30 employee at Coinbase, who I flew combat missions with, he didn't tell me to join Coinbase in 2013. He really should have. He's not that good a friend. He invested in us as a seed investor and then used our software and said, "Oh, I overpaid by $250,000 because I have no idea how to account for any of this." So he sent in our audit report to the IRS, and the IRS said, "No, we're going to audit you. We're not going to give you a $250,000 refund." And then they looked at it and like, "Oh, okay, like we owe you a $250,000 refund." So like if you want to take the stress out of things, have a lot of automation, have great customer support. We do work with CPAs. You can find CPAs that are experts in using our software, but also experts in income, real estate, onshore, offshore vehicles, IRAs. We can make those introductions as well. So this is like a very exciting investment class. Like we're working with cutting edge investors and technologists and builders, but also on the compliance side, like the accountants and lawyers and investment advisors that are leaning into the asset class as well.
That's incredible. Thank you so much, Pat. And thanks for that overview. Ben, you did an absolutely incredible job. Thank you for the questions. I'm going to ask you one last question to finish out. Coming from the Big Four, what's just some, I don't want to say the word challenges, but maybe, has kept you up at night, maybe hitting your head against the wall a little bit, or some surprises that you've had. We have a lot of different products at Valkyrie, and just from the tax perspective, what's been most surprising in your journey at Valkyrie? And you've been with us for a while now.
Yeah. So from a tax perspective, my most surprising aspect is the fact that everybody has their own opinion. And I say that because, at EY, obviously I spent a lot of hours on Ernst & Young webcasts and Ernst & Young, items similar to this. But since leaving to get my CPE, I've spent a lot of time on Deloitte and KPMG and PwC as well. And I feel like every webcast I attend related to cryptocurrency, there's slight variations here and there between the Big Four, even at the Big Four, where theoretically they are talking on a daily basis to make sure that the SEC and IRS and otherwise are keeping in check. There are some differences of opinion, and that's why it's so important, as Pat and I were discussing about the next few years of regulation, because right now there are no rules. It's the Wild West, and it's really just how your tax advisor takes a certain rule not related to crypto and applies it to your crypto holdings. So the fact that the industry is so large and just continues to grow, it really surprises me that the IRS and the SEC and Congress really are still just taking it cautiously and moving, not even step by step, but inch by inch, because it's outgrowing the necessity of better rules.
That makes sense. Well, we're all in it together. Pat, again, it's wonderful working with your firm and working with you. We're really happy about that partnership at Valkyrie. Gentlemen, this has been extremely helpful, very advanced, but you also helped on some of the, the surface level questions too. But I think that there was definitely a lot in here for everybody. So, closing out, everybody, thank you so much for joining us today. Pat and Ben, thank you for doing this, and have a fantastic day.
Thank you.
Thanks.